But the real squeeze, Shae, comes very differently. It comes from reversion to mean. It comes from arithmetic, not narrative. In the US, I don't know the Australian numbers, but in the US, precious metals and precious metals equities comprise 0.5% of total savings and investment assets in the country. The 3-decade mean is 1.5%. And I believe that a combination of quantitative easing, which, as you know, I call counterfeiting, debt and deficits, and negative real interest rates will, over the next 5 years, cause demand for precious metals and precious metals assets to at least return to mean. If they return to mean, it means that demand will triple. It means that the silver squeeze will not come from a young wage earner on his or her cell phone, but rather will come from the AMP. It'll come from Temasek. It'll come from the Harvard University Endowment. If we have reversion to mean, it means that the market share of precious metals and precious metals equities will triple. I actually think that they will do more than revert to mean, but I don't need for them to do more than return to mean. If they merely return to mean, you will see what the real gold squeeze looks like. You'll see what the real silver squeeze looks like, and you'll see, I think, not merely a meaningful, but a surprising response in the equities. Is this going to happen over a period of time that will keep your most rabid listeners happy? Probably not. You know, there are many people who adopt the narrative and they want it to take place over a long weekend. And that isn't the way markets work. But, you know, Shae, in the past, you and I have talked a lot about the Barron's Gold Mining Index. When people look at that chart and they look at the anatomy of prior bull markets, what they see is that although the market doesn't give you what you would like to expect when you want to expect it, it is very common over the course of a precious metals bull market to see the index go up 700 or 800%. It is not uncommon to see it go up 100% in a 12-month time frame. The point of that is that although it can bore you in the 2 or 3 years that it isn't moving or is moving down or is in malaise, from a time value of money standpoint, if you're in place for the market when the market moves, the rent it pays you overcomes almost any discount that you might want to charge yourself waiting for it to wait.
I just want to draw on something you said in there. You called this the last precious metals super cycle of your career. Tell me, what identifying factors do you use to define a precious metals super cycle?
I think that we're in a unique circumstance right now. I think that we're coming out of a 40-year cycle that featured rising bond prices and lower interest rates. And I don't think that you can take interest rates meaningfully below zero. So I believe that if we are not at the end of the bond cycle, we are much closer to the end of the bond cycle than to the beginning. And I think that ultimately bonds and gold move countercyclically. Bonds are a good time investment. When they're cutting the interest rate, they're raising the value of existing cash flow streams. And if the expectation of the future is benign interest rates and benign economic conditions, nobody's afraid of anything, so nobody buys gold. In a circumstance now where the arithmetic around debt instruments is so bad, yet the prices of debt are still so strong, I think we're coming in for a sea change. Think about yourself, Shae, as the holder of a U.S. 10-year treasury. I know you wouldn't be, but put yourself in that shoe anyway. You loan the U.S. government, which is an increasingly bad credit because of debt and deficits, money for 10 years. And they promise to pay, which they do, absolutely, pay you 1.5%. So far, so good. But they pay you in a currency which they, not some cranky old libertarian, they say is depreciating in value by 6.5% a year. That means that the US government absolutely positively guarantees that they're going to cost you 5% a year in purchasing power compounded. This is the first promise in my lifetime they're likely to keep, other than their attempt to send me to Vietnam, neither of which I had much interest in. So I believe that over the next couple of years, the lessons that we've learned over the last 40 years, which is to say that life is benign, government is good, the Fed is your friend, there is a Fed put, that there's a fat guy in red that comes down your chimney this time of year. All these things, I think, are going to begin to fade in prominence against the arithmetic of getting paid 1.5% in a currency that's depreciating by 6.5% a year. The consequence of that doesn't need to be a replay of the 1970s, which saw gold go from $35 an ounce to $850 an ounce, and saw the interest rate go from, 4.5% to 15.5%. It doesn't need to be that dramatic. It is estimated, by the way, then that the market share of precious metals and precious metals related securities in the United States was between 8 and 9%, rather than 0.5%. All I'm suggesting is that the combination of the end of the benign bond era from 1982 to 2022 and quantitative easing and debt and deficits and negative real interest rates will cause the market share of precious metals and precious metals related securities to revert to mean. And if that happens, demand triples and supply can't.
Now, I have one final question before we wrap up today. And it's another question that I receive from people who watch this channel. It is, what is the one thing an investor should know when they start out on their investing journey?
Well, that's a tough question. I think investors need to know that money is made investing on the delta between price and value. Most investors pay slavish attention to the price of something, the price of a stock. It's $1 a share. What good is that knowledge if you don't have an opinion as to what it's worth? So I think that money is made investing ultimately on the delta between price and value, and also made in a sense in terms of forecasting what might cause that value to occur, over what period of time might it occur, and what is the probability of that occurrence. Many people confuse themselves too much with investing, but really it's a function of buying a good asset at a fair price and letting time take its course. The second thing I think investors need to know is that time does need to take its course. The eighth wonder of the world, and the first wonder of the world around investing, is compounding. And compounding takes time. The great fortunes of the world, Buffett, fortunes like that, took place over very, very, very long periods of time. If you get out your calculator, programmable calculator, and you take a fairly unremarkable rate of return, say 7%, you take 100 times, 107 times 107 times 107 times 107 times 107. The number that you get in the out years is incredible. But that supposes that you held the investment to see that compounding occur. It's ironic that when I was a young man, I was very impatient. When I had lots of time on earth, I wanted my so-called investments to perform in 3 months or 4 months. Now that I have substantially less time left on earth, I've become much more patient. It isn't that I wouldn't like to see immediate gratification. It's just that I've come to understand that what I want doesn't matter much. And I need to adjust my expectations with what I might be able to reasonably expect to occur. So I invest now in sort of 5 or 6 year chunks. I'm often, as you know, early, but I'm usually right. And I've learned with time, I get to ask myself questions where the answer begins with when. Most other people ask themselves investing questions where the answer begins with if. And when is a much more certain outcome than if. I've come to prefer when questions to if questions. So in answer to your question, not one, but two. One, money is made on the difference between price and value, which presupposes that you can establish what you think is fair value, because price is easy to find. And the second is make time on your side.
That is an incredible answer, and I hope people take something away from that. Now, before we wrap up today, I do believe that you like to make an offer to people watching your videos
I
regarding
do.
ranking their commodity portfolios. Tell me, are you still making that very generous offer?
I am. I've had so much fun doing it. I've had thousands and thousands of conversations, some in rural New Zealand accents that I can't understand, but that's okay. The offer goes like this. If you've liked what you've heard so far, but you want a more specific discussion with me around your own stocks, have it. Go to a website, ruleinvestmentmedia.com, enter your natural resource stocks. Please no crypto, please no pot stocks, please no tech stocks. Keep an old man to what he does well. I'll rank your portfolio 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments might have value. By the way, I got an inbound request today from a young woman named Shae Russell, which I appreciate. Sidebar. If you mention charts, I will send you the Barron's Gold Mining Index, not because I'm any expert in technical analysis, but rather because if you examine the 2 prior bull markets in precious metals, I think you'll get a better sense of the anatomy of this one. I think it'll make you a better investor and speculator. And for those who care, and every Australian should care, I'll include a 100-year commodity chart, which talks about the prices of commodities relative to other asset classes. The thing that I learned that I can do now, because I'm no longer a broker, is if people care, they can add the comment private placements. And if they're accredited, I can simply tell them what private placements I'm doing. Since I don't get paid commissions anymore, it turns out that I'm covered by commercial freedom of speech because I'm not paid for this. I'm giving it away. It's amazing that I had to take a vow of poverty to get out from under the regulatory morass, but that's what I've done. So ruleinvestmentmedia.com, I'll rank your stocks. If you mention charts, I'll include charts. If you care what I'm doing in private placements and you're an accredited investor, write down private placements too. Have it all.
Look, that is a fantastic offer. And as Rick did just cheekily mention, I absolutely ran myself through the gauntlet last night just to get a take on what the user experience is. And I was pleasantly surprised. All right, Rick, look, I've just got to say that is all I've got time for today. I have thoroughly enjoyed today's conversation. I absolutely promise I will buy you a beer and maybe even something higher up the shelf.
I'm almost certain that you will, Shae. Thank you.
Thanks, Rick.